Adjusting journal entries. Adjusting journal entries are entries made in a general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. Adjusting entries do not include cash because when adjusting entries are recorded, cash transactions have already taken place or will take place in the future. There are 4 scenarios that can occur. Under the cash basis, revenue is recorded when cash is received and expenses when cash is paid. Scenario 1. Cash is received before revenue. Adjusting entry would be deferred revenue is earned. Scenario 2. Cash is paid before expense. Adjusting entry would be deferred expense is incurred. Accrual accounting records revenue when cash is earned and records expenses when cash are incurred. Scenario 3. Cash is received after revenue. Adjusting entry would be accrued revenue is earned. Scenario 4. Cash is paid after expense. Adjusting entry would be accrued expense is incurred. So I'll be demonstrating 2 examples, Scenario 1 and Scenario 3. On the 15th of March, Sue buys a Qantas plane ticket to travel from Sydney to Melbourne for $300. On the 27th of June, when Sue travels to Melbourne, Qantas receives $300 for the plane ticket. We will assume that Qantas prepares financial statements at the end of each month. The adjusting entry would look like 30th of June, unearned revenue $300, service revenue $300. As Qantas has provided service, it would see the liability account decrease and the revenue account increase. For example, Scenario 3. On the 27th of August, Lenovo agrees to provide service for Thomas to fix his computer for $200, and Lenovo bills the work on the 9th of September and receives payment on the 10th of September. Because the accrual basis requires it to record revenues when they are earned, the adjusting entries would be 30th of August, debit accounts receivable $200, credit service revenue $200. These C's are both an increase in accounts receivable and service revenue.